Have you ever wondered how banks really work? Or what happened behind the scenes with that whole Silicon Valley Bank collapse? Well, you're not alone. We've had tons of requests to dive deeper into the world of banking, and we're doing just that today, unpacking how banks operate, from ancient history to the modern financial system that impacts our lives every single day. Stick around because what we're about to cover will give you a whole new perspective on money. Hey there, welcome to The Global. We create content that helps you understand the world of business, money, and everything in between. Today's video is a little different. We're tackling something that gets a lot of questions. How do banks work? Now, whether you're a business owner, investor, or just someone curious about how the financial system works, today's video will break it down. We're going through everything from the first days of banking in ancient times to the rise of the modern-day financial system. And I promise, by the end, you'll get how all this affects you. 1. A brief history of banking. Let's take a step back in time, way back. Believe it or not, banking isn't a modern concept at all. In fact, it dates back to ancient civilizations. The first evidence of banking activity can be traced all the way to around 2000 BCE in Mesopotamia, often regarded as the cradle of civilization. Back then, merchants would lend grain to farmers and traders, functioning as an early form of credit. The reason grain was so important? It was a commodity that could be used for trade and as a form of currency. In this early banking system, there was no paper money or digital transactions, just real, tangible assets being exchanged in the form of goods like grain. As civilization grew, so did the complexity of banking. In ancient Egypt, Babylon, and Greece, temples and palaces became the early banks. These institutions didn't just store people's valuables like precious metals or jewels. They also acted as lenders, offering loans to citizens. Temples, in particular, were trusted by the public to safeguard their wealth, and they even issued loans, sometimes using the temple's vast reserves as collateral. These early systems of banking helped fuel trade, both locally and across vast distances, laying the foundation for economic stability and growth. Now, let's zoom forward a few centuries to the Roman Empire, a society that really took banking to the next level. By around 100 BCE, Roman banking was thriving, and argentari, or money changers, were essential to the economy. They operated in the Roman Forum, the center of public life, and offered services like currency exchange, lending, and even taking deposits. The Roman Empire's banking system was sophisticated in its own right, with money changers acting as intermediaries, allowing traders from different regions to exchange foreign currencies and thus facilitating trade across the empire. The Romans didn't just trade goods, they traded money, which had evolved into something that could be stored and transferred with ease. But let's skip ahead a bit. Fast forward to the 14th and 15th centuries in Renaissance Italy, where families like the Medici started to make a lasting impact on banking. The Medici family, in particular, played a pivotal role in shaping modern financial systems. They were not only wealthy bankers, but also patrons of the arts, and they essentially pioneered a new way of doing business. They introduced the concept of double-entry bookkeeping, which was revolutionary for its time. This method allowed them to track financial transactions more accurately, a crucial development for businesses as they expanded and engaged in more complex financial dealings. Their innovations didn't just stop there, they also helped establish some of the first central banks in Europe, including the Bank of Amsterdam in 1609, which was the first to issue paper money. The Medici and others laid the groundwork for today's banking systems by setting the stage for institutions that would handle the complexities of modern economies. By the time the 17th century rolled around, the foundations for central banking were in place. Banks like the Bank of England, founded in 1694, were established to not only offer banking services, but also to regulate and stabilize national economies. They started to provide governments with a way to manage national debt, and their influence on international trade and finance grew exponentially. These early central banks became the pillars upon which modern financial systems would be built, helping to shape the global economy we know today. 2. The gold standard, what went wrong? Now let's dive into one of the most significant and ultimately flawed systems in banking history, the gold standard. Under this system, countries pegged the value of their currency to a specific amount of gold. The idea was simple. If a country had a certain amount of gold in its reserves, it could issue currency equivalent to that amount, ensuring that the currency had a tangible value. This helped create a sense of stability in the global economy, as people could exchange their paper money for gold at a fixed rate, which also facilitated international trade. However, the gold standard came with some serious limitations. The most critical flaw was its rigidity. Since the money supply was tied to the amount of gold a country had, governments couldn't adjust the currency supply in response to economic conditions. During times of economic crisis, such as recessions or wars, governments needed the ability to print more money to stimulate the economy or pay off debts. But under the gold standard, they were restricted by the amount of gold they held. This became especially problematic during the Great Depression in the 1930s, where countries needed to increase liquidity to recover, but could not do so because their currencies were tied to gold reserves. The system also created tension between countries with trade deficits and those with trade surpluses. Countries with deficits had to send gold abroad to settle their debts, which drained their gold reserves and created economic instability. This caused countries to abandon the gold standard one by one, especially during the pressures of World War I. In the aftermath of World War II, a modified gold standard was established under the Bretton Woods Agreement, where the US dollar was tied to gold, and other currencies were pegged to the dollar. But even this system couldn't survive. By 1971, after years of economic challenges and inflationary pressures, President Nixon officially ended the convertibility of the US dollar into gold, effectively bringing the gold standard to a close. The end of the gold standard marked the beginning of the modern-day system of fiat money, where currency's value is based not on physical commodities, but on the trust in the government and financial systems backing it. The gold standard may have provided stability in its time, but its inability to adapt to economic crises ultimately led to its demise, leaving behind lessons about flexibility and the need for responsive monetary policy. 3. Enter fractional reserve banking. Here's where things get really interesting. After the collapse of the gold standard, the world entered a new era of banking, fractional reserve banking. In this system, banks are only required to keep a fraction of the money you deposit as reserves, typically around 10%. The rest? They can lend it out to individuals and businesses. At first glance, this might seem like a risky move. After all, how can a bank lend out most of your money and still ensure it can pay you back when you want to withdraw it? But the system works because not everyone demands their money back at once. While this might seem risky, it's the foundation of modern economies. By lending out money, banks fuel business growth, create jobs, and stimulate economic activity. But the flip side is that fractional reserve banking can lead to inflation if banks lend too aggressively, creating too much money in circulation. And as banks take on more risk to increase their profits, they can sometimes push the system to the edge, leading to financial crises when things go wrong. This delicate balance between growth and risk is a key challenge for modern financial systems. The 2008 financial crisis and why it matters. We've all heard about the 2008 financial crisis, but it wasn't simply bad luck or a random economic downturn. It was the direct result of excessive risk-taking by banks and financial institutions. Leading up to the crisis, banks were lending money recklessly, particularly in the housing market. They gave out subprime mortgages, loans to borrowers with poor credit histories, while also engaging in risky investment practices like mortgage-backed securities. These actions created a massive financial bubble that eventually burst when home prices plummeted, leading to widespread defaults and bank failures. What made things worse was the interconnectedness of global financial markets, which spread the fallout far and wide. Governments stepped in with emergency bailouts, pumping billions into the system to stabilize the economy. But here's the kicker. Even though the crisis was solved in the short term, the underlying issues didn't disappear. Banks are still incentivized to take risks, and the financial system is still vulnerable to the same kinds of problems. We've seen reforms and regulations, but many experts argue that the fundamental flaws in how banks operate remain largely unchanged. The 2008 crisis serves as a stark reminder that unchecked banking practices can have devastating effects on the global economy. 5. Types of banks and what they do. So, now you know a little about how banks work, but not all banks are the same. Let's quickly run through the different types of banks you'll encounter. 1. Retail banks. These are the banks you interact with daily. They handle everything from savings accounts to personal loans. They lend out money to people like you and me to buy houses, cars, and more. 2. Commercial banks. These guys cater to businesses, helping them with everything from business loans to international trade. They keep the economy moving by providing capital to companies that create jobs. 3. Investment banks. These are the big players who help companies raise capital, handle mergers and acquisitions, and trade securities. They're the ones behind the scenes in high-stakes financial deals. 4. Central banks. Finally, we've got central banks, which don't work directly with you or me. They control the country's money supply, set interest rates, and regulate other banks to keep the financial system stable. Now that you know the basics, let's hear from you. What do you think the future of banking looks like? Will we see a rise in digital currencies? Or maybe a shift back to gold? Drop your thoughts in the comments below. I'd love to hear your vision. If you found this video helpful, don't forget to hit that like button, subscribe to The Global, and ring the bell so you never miss out on future content. We've got a ton more videos on business and money coming your way. Alright, so we've covered a lot today, but hopefully you now have a clearer understanding of how banks work and why it's important to pay attention to the financial system. This is the foundation that affects not only your wallet, but the entire economy. Thanks for watching, and we'll catch you in the next one.